Well, it is frustrating, but there are reasons to believe that this is the last one. The Bank of Canada increased its overnight rate by 0.25% again this week, which brings the retail prime rate to its highest point since April of 2001. That's actually 22 years ago. Prime rate's now 7.2%. In June, the bank increased its rate 0.25% after the April inflation numbers came out. They showed an uptick. However, after that, we've since gotten the May inflation report, we've gotten the jobs report, and on both of those, inflation's down and the number of jobs is also down. And I hoped that this would stop the bank from one more increase, but the economists and the bank, they had some other ideas. Leading up to this week's announcement, 20 out of 24 economists polled by Reuters expected this rate increase, but they also said that it would probably be the last one for the year. Changing from forecasts earlier this year, the timeline for likely drops to the rate is now pushed further into 2024, and economists and the bank alike don't think that inflation will hit the bank's 2% target until 2025. So what does this mean for you as mortgage holders? Well, for those of you with variable rate mortgages that have adjustable payments, this will mean about a $15 per month increase in your payment for every $100,000 that you owe on a mortgage. So if your mortgage is, say, $400,000, it's easy math, $60 extra per month. And I know that that hurts. For those of you who are in a fixed rate mortgage, however, this doesn't really impact you unless your mortgage is up for renewal soon. And if that's the case, for sure, please reach out to me and my team. For any of you looking to get into a new mortgage or who are up for renewal, we have seen fixed rates also increase over the past 4 weeks, but they're still a lot lower than the variable rate mortgages that are currently available. Most new mortgages will have a rate above 5%, but as of today, when I'm recording this, we can still do a 4.99% 5-year term in certain cases. So reach out if you want to look at that or locking in that rate with the idea of a purchase over the next 4 months. Now back to what caused this rate increase. The central bank has been grappling with a delicate balancing act, trying to rein in the inflation, which has been too high, but without stifling economic growth. The Bank of Canada Governor Tiff Macklem, he suggested that residual pandemic savings might have delayed the impact of these higher interest rates in their efforts to curb inflation. And that's right, it might sound horrible because it is. He's actually blaming you for saving more money. Even though inflation in Canada has eased all the way down to 3.4%, which is by far the lowest rate in a while and more than half of what the rate was only a year ago, still more than half of the components that are in what's called the Consumer Price Index basket have actually been increasing more than 5%. So some are lower, but there's certainly several that are still higher. Philip Peterson, he's the chief investment strategist at IG Wealth Management. He believes that the next 12 to 18 months will determine whether or not this additional rate hike was the right decision for the bank. He pointed out that the central bank did not rule out further action, indicating that it's possible we might still see an additional increase. There's still some suggestion that maybe that will happen in September. Hopefully not. Now, however, as the interest rate effects continue to permeate through the economy, the Bank of Canada expects economic growth to slow down, with an average of about only 1% for the last half of this year and the first half of 2024. It projects that GDP growth will be at 1.8% this year, 1.2% next year, and maybe something closer to 2.4% in 2025. We can talk about GDP, or you can look through the website, and we have a page that actually explains in more detail what that is. Now, regarding inflation, that's the whole reason behind this. It's the price instability. It's the increased cost of everything. The bank does expect it to hover around this 3% mark. We're almost there. The United States just barely beat us to that mark, but we're almost there. They do expect it to hover around that 3% mark for the next year or so before gradually dropping down to the target of 2% somewhere in 2025. The return to this target is slower than they anticipated before, which means we might see some more price instability for a little bit longer. Now, as always, my team and I are looking forward to and are ready to hear from you and are here to answer any questions that you might have. Look forward to hearing from you. Thanks so much.